What's up, everybody? It's another week of Wealth Webinar. And this week, I am so excited because I get to show you a brand new concept, a brand new way to use a concept that's been around for hundreds of years that we talk about. And what is that concept? Nothing other than the infinite banking concept. But what if I could show you how you can save money and spend money at the exact same time without ever interrupting the interest that you earn on your money? But then what if I could show you how just by changing one additional thing, the spread, or in the world of finance, it would be called the arbitrage, all of a sudden becomes bigger. In other words, if you were able to make 5% on your money and pay 4%, your arbitrage would be 1%. But what if you could then just do one little change, like wave a magic wand, and all of a sudden you're making 5, but now you're actually only paying 3.25. See, that spread just got bigger, and all we did is work with this guy, Russell, here, and he showed us the way. So we are joined with Russell. Steven's going to join us. Welcome to the show, Russell.
Hey, Chris, thanks for having me. Happy to be here. Great opportunity to share this product from Coastal States Bank, and it's a great tool to have in your financial plan. It really unlocks the value of the life insurance within your financial plan. Most people refer to it, a lot of people refer to it as an insurance-backed line of credit. We call it a cash value line of credit. And essentially what we're doing is we're taking the bank takes a collateral assignment on the cash value of the life insurance policy. And instead of borrowing it from the insurance company, you come to the bank and borrow the funds at a much lower rate in the form of a line of credit that's a lot more flexible than a policy loan. So just to give you a little of the details of our product that we offer, we're offering a 5-year line of credit where, as I mentioned before, we take a collateral assignment on the value of your life insurance policy. And the rates on these lines of credit are variable, and all of our rates are pegged to Wall Street Journal Prime, and our rate spreads are really aggressive. So I'll just run through the rate spreads really quick so everybody knows what they are. The rate spread is going to be determined by the size of the line or the total cash value inside of the policy. And so we currently have a minimum line amount of $100,000, but from $100,000 to $250,000, we're offering Wall Street Journal Prime minus 50 basis points. And then from $250,000 to $1 million, we're offering Wall Street Journal Prime minus 1%. And then from $1 million and up, we're offering Wall Street Journal Prime minus 1.25%. Now, all those, whether you've got a $100,000 line or a $10 million line, we have a floor rate that currently applies, and our current floor rate is 3.25%. So Prime currently equals 3.25%. So like I said before, whether you got a $10,000 line or $10 million line, everybody's borrowing at an effective rate of 3.25%. But let's use, 500,000 as an example. What that means with your variable rate spread is today, if you were to set up a line today, you'd be borrowing at 3.25, but Prime would have to climb above 4.25 for you to move off of our floor rate. So really aggressive. And there's multiple ways that we set up these lines of credit. I don't know how most people own their life insurance, but for individual borrowers, there's 2 different ways that we set them up. This is very important to pay attention to. So if you there's 2 ways you can designate the line of credit. One can be for a consumer purpose. If you designate the line for a consumer purpose, the line of credit will get reported to the credit bureaus and will show up on your credit report. That can be beneficial, or it can hurt your credit score depending on how much you've borrowed on the line of credit. So something to think about. Most of our clients are designating their lines of credit to be for the other option, a business purpose. And if we designate the line for a business purpose, it functions more like a policy loan. It doesn't get reported to the credit bureau, so it doesn't show up on your credit report, and it won't affect your personal debt to income for future personal financing. So
hey, Russell, let me just hold on. We're getting right into the meat of this, but a lot of people have no idea what we're talking about. You got to remember, this isn't a group where every single person understands the cash value line of credit. I even have people that are already commenting, and note, I'm not going to name a name, but somebody just put a comment up, and I want to I want to be very clear about something. Like, you might not like me for doing this, but I'm going to call you out if you put something up that I got to just call you out on. Will Rogers made a quote that said, "The biggest problem in America is not what people don't know. The biggest problem in America is what people think they know that just ain't so." Everybody's so fast to think they know what they don't know, so they post comments that they have no idea what we're even talking about or how it works. And then all of a sudden, and this isn't a bad thing, but maybe they think that they've got a better way to do it when they don't even know what we're talking about. So what I want to do, Russell, is, we're going to be here for a little bit. I didn't want to get right in bed, and kind of like start, getting into the fun stuff. I got to take them back a little bit and just explain to them how this works, because otherwise we're going to have a bunch of people thinking they know what they don't know, making stupid comments, about things that they don't even understand, i.e. REITs, real estate investment trusts. I was an advisor for 16 years, and one of the most toxic asset classes we ever put our clients into were none other than REITs. And we learned what the shortfalls were on REITs, because they paid great yield, but then they had additional downfalls, as we never knew what they were investing in. And in 2009, poof, they blew up. And some people are like, yeah, but that was 2009 when the market in the real estate market exploded. What do you think is going on out there right now? Anyone looked at the price of real estate? Anyone looked at the hockey stick going on in Wall Street and also real estate? Like, the bundles of real estate inside these publicly traded REITs is toxic in most cases. If you own a REIT, you probably don't even know if you own a REIT that has that Evergrande stuff in it. You don't know, that's real estate, but if you have any exposure to that. Have you read the prospectus? Do you understand the holdings? Listen, I'm not trying to contradict what you said. And if you don't like it, like, you can just jump right off, no big deal. But I just like being transparent. And I want to make sure that everybody understands this. REITs carry risk. What we're talking about, which I'm going to explain it, carries zero risk. There is no risk with what we do. It is guaranteed. It is like your savings account. You're talking about a highly risky asset that, yes, maybe it earns 7, maybe it earns 8, maybe it earns 15%. That's irrelevant, because past performance means nothing for future results. And then what you're talking about is using a margin-based line of credit. Russell, I don't know do you guys do those where you take a portfolio of stocks and you'll issue a line of credit on them?
We do, but to what you just mentioned, we don't like doing them right now because of the inflation.
Imagine that. Really? You guys don't like those right now? Like, everybody's rushing through the markets. Everybody thinks the stock market's never going to end. It's going to go to the moon. And you guys don't want to issue money based on the solid, secure, portfolio of stocks and REITs and things like that. You guys don't want that?
No, we'll do them, but we don't prefer to do them just because of the volatility of the market and the risk that's involved.
Yeah, I don't mean to be an asshole, but sometimes that's the only way to get in people's heads. So if you don't like me, awesome. We're going to be good friends. If you love me, we're already friends. So that's kind of how I operate. Like, I got nothing to sell you folks. Okay. This is just education. I don't manage your money. I don't want to manage your money. So just take it at face value that I'm giving you the truth of how things work, for no other reason than I want to educate you so you can be the best steward of your money. And hey, listen, maybe REITs are the right thing for you. I own a REIT in my Charles Schwab portfolio, but it is a private REIT that was issued back, a while ago, office and industrial. I knew every single company and every single address of every single piece of property in that portfolio. It has paid me probably roughly a yield of about 6 to 7%. The problem with it is it's private, so I'm having trouble with liquidity. If I want to exit that, I can't just take all my money back. So there's private and public REITs, real estate investment trust. Public are the ones you buy, from your broker, from, any publicly, exchange or anything. Privates are different. You have to actually seek them out. You can hold them in your brokerage account, as I did with Schwab, but I want to get off of the stock market, because what I'm talking about is not the stock market, is not REITs, it's not an investment asset at all. What we're talking about is a strategy that's been used by the wealthiest families in history, those of the Rockefellers, Rothschilds, the JPs, the Morgans, the Walt Disneys, the Ray Krocs, Doris Christopher from Pampered Chef, Warren Buffett, right up to your sitting president, Joe Biden, love him or hate him, and McCain before he died. They all use this. Every single one of them, factually, watch the videos, do your due diligence. They use this. So the biggest thing that people need to understand is why aren't you? And a lot of the reason is people just don't know about this. The commissions that are paid on this product that I'm going to show you, and I hate even referring to it as a product, but we got to start somewhere, are 60 to 90% less than what your broker, your broke-ass brother-in-law that sells life insurance is getting. So what are we talking about? Let's come over here. So we call this the money multiplier policy. Okay. And all it is a whole life policy. Whoa, I just smacked you in the face. All you are like, whole life. Dave Ramsey and Susie Orman and all the smart folks out there, unlike you, Chris, you're not the smart guy like Dave Ramsey, say that's the worst place to put your money. But you know, Dave Ramsey doesn't even understand this. He's made it very clear when he put a video up trying to explain it to his audience in a negative way. And he literally fell right on his face. He had no idea what this is. He understands what whole life, as I do too, and regular whole life would probably not be the best place for you to put your money. I'll be honest. Dave's right. Susie's even right. Regular, plain Jane whole life insurance. If you're buying it to use it the way that I'm about to show you, I don't know. Don't do it. Like, you're going to be really upset, and that's not what I'm showing you. What we're talking about is a specially designed and engineered whole life policy that is built completely backwards from the whole life Dave Ramsey's talking about. Matter of fact, Dave Ramsey would probably love us if he actually understood it, because Dave Ramsey loves term insurance, right? He's like, buy term, invest the difference. I feel like, we kind of do the same darn thing. We use a base whole life, very specially designed. We strip it down enough and take all the death benefit out of it. And we support the death benefit just because of the IRS requirements with term insurance. So Dave loves term. Dave, check this out, buddy. Like, look at all the term insurance we're using inside this contract. Dave, you said it. It's cheap, man. Look at all the term insurance. We do that to keep the internal cost down and the cash value high. And when we design it, this policy, okay, this is that whole life I'm talking about, we are basically going to have access to our money no less than 30 days after we make our premium deposit. Now, I don't know if any of you have ever had a whole life that even had cash value available in the first year, maybe not even the second year. Ours, the way they're designed, you have access to it immediately in the first 30 days or when your check clears. So now you can understand it's completely different. And how much money will you have access to? That depends. It could be anywhere between 60% of your deposit all the way to, like, just the two that I've designed the last 2 days have 95% available immediately. And what we're going to get into with what Russell's talking about is the next phase. So why would we ever put our money into this vehicle? Because everybody, watching before I even got out explaining what the heck this was, is thinking, I'm making more in REITs, I'm making more in stocks, I'm making more in crypto. Stop. Just stop. Stop thinking you know everything and just learn one additional thing and it could change your life. Yes, you're making more in stocks. Awesome. You're making more in REITs. Awesome. So am I. I'm making more in crypto. Like, I bought crypto last week at 41. It's at 55 today. Like, it's been a good day. Like, not bragging. I understand that. But you see, the difference between how I'm making money and how you're making money is I'm making money twice without doing any additional work. How many of you want to make money twice doing exactly what you're doing today, investing in what you're doing today, buying cars and all that stuff? You want to make money twice without getting out of bed? Then stop thinking you know what you think you know and start listening. I'm just here to teach you how to do that. And it's not complicated. And it starts with this. We put our money in this specially designed whole life because that's what the wealthy do. And you know who else does this? Traditional banks, folks. Russell, you work for a bank, right?
Yeah.
He works for a bank. They understand this because banks are the #1 purchasers of whole life in the world, I think. Look at Bank of America, Wells Fargo. They own more whole life than they do all the land and buildings on their balance sheet. Double check my math. It's absolute fact. Google, just go to Google and say, how much whole life do banks own? The first line, the first thing that comes up, Investopedia, $190 billion. Folks, I'm not making this stuff up. I'm just trying to open your eyes to say, banks are doing this, the wealthy are doing this. You're not, simply because you have never been shown how this works. So we already went over, we're going to change one thing. So let's just say you're saving money today. You're saving money. I don't care. Let's just call it $1,000 a month. You save that somewhere. Maybe it's going into a 401k. Maybe it's going into a savings account. Maybe you're putting it in a checking account. Maybe you got a Coinbase account for crypto and it's going in there. What if, just imagine this, okay? Just play along with this. What if all you did is changed one thing? You added one step. Before the money went into your investment, you changed where the money was housed first. Okay, hear me out. You just changed who holds your money. Right now, your money, chances are, when you make money, it's going into somebody else's bank. No disrespect, Russell, because I know you work for a bank, but it's going into someone else's bank. But what if we just changed whose bank held that money first? And what if we put it into this account where, and I got to be careful right now. So the current contracts as of today, which is October 6th, pay a guaranteed contractual 4%. That is changing. So come October 23rd or at the latest November 1st, any of these contracts that are done after that date will be a lower interest rate. How much lower? I don't know. 375, 325 is numbers I've heard. It's going down. It is what it is, folks. Like the government came up with 7702. But today it's 4%. Plus we get a dividend, which is not guaranteed. See, I can put the big G behind the 4%, but the dividend is not guaranteed. But the companies, all of them that we work with, have paid dividends in excess of a 100 years, some are 168 years, consecutively without ever missing one. Let's go one step further. So I'll put a number. Today, the dividend, the highest one that we do is 2%. So you're all in making 6% right here, of which 4 of it is guaranteed, 2 is not, but the 2% is the lowest dividend that company has paid in 31 years. Probably longer, but I can only show 31 years. So now, if we just change where the money goes first, it doesn't go into somebody else's bank, it goes into your bank, and then we have the ability to then earn 4% plus the dividend on that money. We're doing better than what you're doing in your traditional bank. Now, hold on, we haven't got to stocks and mutual funds and REITs and crypto yet. So now, once we put the money in, I said you can take that money out immediately in the first 30 days. But when you take that money out, and this is where Russell really, like, he's going to become your best freaking friend. When you want to take that money out, now let's just pretend, because somebody on here said that, let's pretend we want to take that money out and we want to buy a REIT. Your end destination for your money that you're saving is you want to buy a REIT. I wouldn't suggest it, but that's what you want to do. And let's just pretend that that REIT, forget about all this, that REIT is going to pay you 8%, okay, yield. Okay, and then if you got this REIT and you got enough money, they're going to give you a line of credit, which is basically a margin line. They're going to give you a margin line of credit, and you can then use whatever money you put in the REIT at, I don't know, what are those things? 2%, 1%. You can use that money at 2%. Believe me, I got a lot of wealthy friends that have these, okay? But you got to have a lot of money in the brokerage to be able to get this. So now this is the end destination. We got a REIT at 8%, and we then can use the money that we put into the REIT at a rate of 2%. Just don't get hung up on the numbers. I'm making things up. So if this is what we want, and this is where we start, check this out. Let's just say we want to take the money from our bank, the specially designed whole life, and we then want to move that money over to this REIT investment, wherever it's held, Schwab, TD Ameritrade, doesn't matter. How we would do that is we would take a loan from the policy. Okay, now this is a swear word. People are like, loan, oh, bad. I don't want more debt. This loan is a loan against your death benefit. This is a whole life policy at the end of the day. The death benefit is paid out when you die. Love it or hate it, okay? It's better than a sharp stick in the eye. So it's paid out when you die. So when you take a loan from your policy, the insurance company is just advancing you some of your death benefit today. They literally let you use your death benefit. And then what they do is they use your cash, let's call this 30,000. They use your cash value as collateral against the death benefit loan. That's what I'm going to call it for the sake of calling it. So your death benefit drops by 30 grand. You have a loan against the death benefit, but like, do you have to pay that loan back? When you go to a bank, okay, when you do a CV line of credit with Russell, you have to pay the bank back. They're not going to just say, hey, you don't have to pay it back. The insurance company says, we don't care if you ever pay the loan back because you're going to die someday. Sorry about the fact, like, I don't mean to hit you with a left hook there, but like, we're all going to die. So when you die, the insurance company just says, hey, cool, man, you never paid the 30 grand back. We're just going to subtract it from your death benefit. We good? We're good. Never have to pay that back. But there is a catch. To use that insurance company's money, to use your death benefit today before you die, the insurance company charges you an interest rate. Today, that interest rate is 5%. So before anyone gets their panties in a ruffle, I just want to kind of explain this. How much did I say that we're making? Roughly 6%, okay, with dividend, today's standards. If we're paying 5, and we're making 6 gross, okay, I'm not getting into the net numbers, but what is your spread? What is your arbitrage? 1%, okay, gross numbers. You're making 1% spread. Okay, so some people would say that's cool because I'm not even making 1% in my bank account. But see, remember, when we took the loan from the death benefit, one thing that didn't happen is none of your money, your 30 grand, came out of your account. Your 30 grand is sitting nice and comfy and cozy inside that specially designed whole life, still earning interest, still earning dividends, uninterrupted, and that will never change. For the rest of your life, whatever the premium deposits are that you put in here will never, ever stop earning interest and dividends for as long as you live. If you understand what Albert Einstein talked about when he said compound interest is the 8th wonder of the world, and then he went on to say, those that understand it, me and some others on here, make it. Those that don't, pay it. Albert Einstein, okay? You might think he's, a smart guy, good at math, but yeah, he was. And he understood this. This 30 grand will do one thing and one thing only for the rest of your life, and that will be go up. Even though we took that 30 grand out, let's just say we took 25 of it to invest in this REIT. So we put 30 in, we took 25K out of that specially designed whole life, which was a loan against our death benefit, and we put it into the REIT. But the insurance company is going to charge us 5, but we're making 6. So technically we're making a 1% spread. It's a good day in the office. Then my REIT makes 8%. I make 1%. But then, the person on here came up with a great idea. They said, yeah, but then I can get a line of credit against my REIT at a lower interest rate, and then I can use this money again. Great. So then let's say we took the money out of the REIT and we invested that in crypto. How much? I made money once, twice, 3 times. How many more times could we play that game? I don't know. It's called infinite banking because it's infinite. So sorry, Russell, I didn't mean to stop you and go back, but now let's talk about something super fun. Some people watching this are like 1%, I don't know. Not even worth getting the medical. I don't know if it just wouldn't be worth my time to do that. I'm just going to take it and put it in someone else's bank and buy the REIT. Russell, if we just change who we use, whose money we use, and if Russell comes in and does the same thing that the company over here would do with your account, and Russell says, hey, we understand whole life. We're banks. That's what we do. We buy this. We'll give you a line of credit against your cash value. We'll let you use up to 100% of your cash value that's available. We'll call it 25 grand, okay, immediately. So we'll let you use all the cash value that's available. But instead of paying the insurance company 5%, what if we just charge you 3.25%? All things have remained the same, except for now we're using the bank's money. The bank, instead of the insurance company, is collateralizing their loan using your cash value. So Russell, correct me if I'm wrong, but it's kind of like a risk-free loan for the bank. The bank has 0 risk.
We love this stuff because it's 0 risk. The only risk is a company like Mass Mutual going under. And if Mass Mutual goes under, we got bigger problems.
Dude, I think if Mass Mutual goes under, all the banks have already died and been,
right.
insolvent. And Mass Mutual's just like, well.
Yeah, you're exactly right. We love this stuff.
So folks, we're going to get into the nuts and bolts, but first I had to take you on a journey. Okay. I had to take you on a train ride to show you kind of how the wealthy have used this. Biden might use this for his political campaigns. The Rockefellers probably used it to lend money back out. Instead of buying REITs, they were lending it out at 12% in banking or whatever they do. Doesn't matter. This is where their money starts. They replaced somebody else's bank with their bank, which has been called for a long period of time, privatized banking systems. You talk to a billionaire or a multimillionaire, chances are they're already using this. Every time I have a discussion with a very wealthy individual and I start explaining this, oh yeah, we know about this. Yeah, we know all about this. It's that thing, that thing, we use this whole life and we borrow from it. They all know about it, but they don't really understand it because they got somebody else doing that stuff for them, kind of like a lot of our clients. But they're all using it and you're just like, duh, of course you're using this. Why would I even think you wouldn't understand this? Well, no, I don't understand it. I just use it because that's what somebody said. They said, this uninterrupted compound interest thing works pretty cool. And hey, so far it has. But the ones that really understand it, the Rockefellers, the Rothschilds, the bankers, and many of the others, they use it at very high levels. So now, remember what I said before? We did the example with the 6, which you're making, And then we did it with the 5 with the 1% spread. So now can we just back into this? And now what am I doing this right? Is it 2.75? Am I doing my math right? 6 minus 325. I think I'm right. Yeah, 275. I'm good at math, but not the best. I'm not Albert Einstein. So we went from 1 to 2.75 and we didn't change anything. We called Russell and we said, hey man, I got these cash value whole life policies. They're worth about 100,000 in cash value. And Russell, he has a minimum, so which you get into that, and he says, no problem. And he said, all right, well, let's do that. I'd rather borrow at 3.25 than pay 5. And Russell then sends you a packet. And you're like, oh, here we go. The bank's sending me over this application. It's going to take me all afternoon. And it's 1 page long. Was it 1 page or was it 2?
It was 1 page with a checklist that had 2 things on it.
Yeah, the checklist I just threw out. And I filled this 1 page thing out. And I remember thinking to myself, Russell, man, I feel like, I was like, Russell, I think you missed something here, bud. Like, you work for a bank. I think you forgot some pages. Russell, like, I got the 1 page all done, but like, isn't there something else? And he's like, no, just send that in. And then like 2 days later, he's like, yeah, you're approved. And I'm like, I've never gone into a bank and said, hey, I want to borrow some money with a line of credit, even if it's secured. And then the bank sends me a 1 page application. And then 2 days later, they say, hey, you're approved. And then as long as it takes to print the checks, they send you a checkbook just like this that is attached to all 7 of my cash value banking policies. 7 policies, 1 checkbook. Dude, they didn't even charge me for the checks. I can't even get my bank, which I've had a relationship with for, I don't know, over a decade. I can't get them to give me freaking counter checks for free. They want to charge me when I walk in. Hey, I ran out of checks. Can I get a couple free? Oh, no, there's a charge for them. $1 each now. Okay, great. You son of a bitch. He just mailed me the checks. And now I get to use my cash value, whatever it is, at a rate of 3.25, very much like, like that person was saying over here with the REIT. But see, now I move the money from my policy into this REIT. The REIT pays me 8%. I'm making a 2.75% spread. And here's where I haven't got you really excited. I'm talking about the first year. Year 2, year 5, year 10, year 20. Guess what happens to this spread that you're making? It goes up because guess what else is going up every day without you working any harder, any longer, taking on any risk or giving up any control? The compounding. Your balance can't go anywhere else but up. If you put 30 grand in, that 30 grand keeps growing. It can't not. That's just the beauty of compound interest. It's why the wealthy fully understand compound interest, but they also understand it's not compound interest I'm really after. That's just where it starts. I need to move my money all the time. I need to take money from my bank, buy REITs. I need to take my money and buy crypto. I need to take my money and pay for my cars. And I'm going to show you something wild. I'm just talking too much, but I get all excited about this stuff. I'm going to talk to you about how me and Shauna's on here yesterday, sat down with the, if I could show you, it's right there. We got one of those big copy machines, those big fancy ones that cost way too much money. And we've been leasing this one for, I think, for 3 years or whatever it is. And our lease was up. And I don't know why we leased. We just weren't thinking. And he comes in and he's negotiating the price of this machine. And he's like, all right, well, your lease payment's going to go up to, I think, $170 a month from $160, blah, blah, blah. And I said, okay. And all of a sudden it clicked. Sometimes our mind wants to drift back to the old way. Well, that's easy. 170. I can do that. We're paying 160 now. And I'm like, wait. Why would I ever pay $160 or $170 to someone else's bank? And then I said to him, I did the math. I added it up. I said, dude, so we're paying $9,800 for this machine? He's like, well, yeah. I said, what's the interest rate? He said, I don't know. Of course you don't. Like, they never know what the interest rate is on the leases. It's buried. Try to go lease a car and ask them, hey, what's the interest rate? Well, it's a lease. I don't really know. Bullshit. The interest rate's like 8% on your lease. They're just trying to hide it from you. So we got down to it and I figured it out. I was paying a bunch of money in interest. I said, how about this? I said, what I want you to do, Mr. Copy Machine Man, I'm not going to give his name, go back and get me the best price if I pay cash for that machine. I want to pay cash for that machine. And this is cool, Russell, because you're gonna play right into this. I want to buy this machine cash. So I think it's like eight, whatever it is, 75 or 8, instead of 96. And then what I'm going to do is I'm going to take one of these checks. I got the check right here. I actually should just start writing it out. And I'm going to write it out to the copy machine company to pay for that machine. And it's just going to come from my cash values of one of my 7 policies, doesn't matter. And I'm going to buy the machine. So we're going to have a brand new copy machine here, bought and paid for, nice and spick and span. And then what I'm going to do is I'm going to say to the bookkeeper, and it could just be anyone, I'm going to say, hey, can you set up $170 a month bill pay to me? That's right. The company for the copy machine, which we've been paying for 3 years, we just never got to keep any money. The company is going to write me a check for 170. You know what I'm going to do? I'm going to take that 170 bucks every month, and I'm just going to pay that back to Russell, which is going to pay my line of credit down, which is going to make that money available. Russell, instead of me saying, if I give you $170 on a loan that I've taken for $8,000, how much more money do I have available the day that check clears?
So if you give me 170 bucks back and you use it to pay down your principal balance, it's available to draw again immediately.
Right. So every month my company writes $170. I just have them pay it right over to Russell's company, Coastal States Bank. And then all of a sudden I've got, guess what? $170 left to use the next day. And every month that 170 just goes on. You guys all know how lines of credit work. It's no different. All right. So now that you all understand this, and I've been watching the chat just explode, and I wish Stephen was on here to answer some of these, but I'll get to them. So now, Russell, now that I've kind of gotten loud, I got excited, I kind of, picked on somebody in the audience, which I often do, and some people love it, some people hate it. Now let's get into the nitty gritty. What's the bad part about this? This can't be this good, man. There's no way it can work this good. Like those whole lives, there's got to be some downsides to them. And this line of credit thing. What are the bad parts about this?
To be honest with you, and I know it sounds sacrilegious to say something like this, I can't see a downside.
To me, there's no fees to set these up. There's no early payment penalty. There's no cancellation fee, no fees at all whatsoever. It's interest only payments based on what's outstanding on the line of credit. And since there's no fees to set this up, this unlocks your life insurance inside your financial plan. It opens up your ability to use your funds exactly how you want to use them, when you want to use them. For planned events, for unplanned events, funds are available immediately whenever you need them.
God, it just sounds too good to be freaking true. There's just no way this can be real. Like there's just no way an insurance company will pay me that guaranteed interest rate plus a dividend every year, allow me to use a large portion of that money immediately. And then I just have Russell with a one-page application, a few days of approval, and however long it takes to kind of get the collateral assignments and the checks back. And then all of a sudden I can just start using my money just like that. Yeah.
Right.
One of our clients literally, and I think you've already spoke to him, he's a doctor. He just set up his policy and immediately got an opportunity to literally steal. You guys all know the used car market's a little crazy right now. He got the opportunity to steal a Suburban, a Chevy Suburban, pretty high demand kind of vehicle. The price he bought this for was ridiculous. It was $18,000 for a new model Suburban. Like, you guys should be salivating. He'll sell that thing for 25, 30 grand overnight on eBay or Facebook Marketplace. And he's setting up a line of credit. So literally, when he got into this thing and he called Russell, Russell's getting him set up, he's just going to write a check and he's going to say, here you go. And then he's going to figure out with bankrate.com how much the monthly payment would have been with that Suburban if he went to a bank and financed it. And he's just going to make the same payment back to his bank. Because what does it matter what your payment is? Would it matter if I charged my company $300 a month for that copy machine? No, the money is all going back into the same place, my bank. If I was writing a check for $300 to somebody else's bank, now we got a problem. Now I need to negotiate that back down to that 170. But it doesn't matter when you're paying yourself back and the money's all ending up in your bank that you can use the very next day. You see the difference between what people do and what they should do is one step away from success. The biggest difference is we use other people's banks and we give up control to other people's banks or Wall Street or whatever you want to call it. If we just change where the money goes first, like the wealthy have and like the banks do with their tier one capital, this is the outcome. There is no gray area. You guys that are analytical, that love to crunch numbers, crunch them away. I got the most analytical son of a bitch sitting right over here. Andrew, I love you, bud. But Andrew, that man can't just look at something and say, yep, that's exactly what it is. He literally needs to go in and sharpen the pencil and just spend days crunching numbers to make sure that what we say is right. I know you're laughing, right? But how much time do you spend just pushing stupid numbers on those Excel spreadsheets that you think we're all going to understand? I take his Excel spreadsheet. He wants to explain them. I throw them away and I just draw it on the board like this because he's just very into the numbers, but he has not been able to punch holes in this. And we even did a video one time where we were literally trying to figure out, like, there's got to be some bad sides. And we went on a mission. Our whole team went online and we tried to find all the bad things about the infinite banking concept and what we do. And we found a whole bunch of negative posts, but then every time we got into them, like, oh, this is the one where this is definitely negative. Nope. Like they were all just propaganda. They were just, I don't know, people that thought they knew what they didn't know. Anyway, Russell, so like, what are some of the minimums? Like, how do people, I don't know how I'm ever going to get to all these chats. This is nuts. How do people actually like do this? And what are some of the minimums? And, you know, like, what would they do if they really wanted to apply this and use this?
Yeah. So, I mean, you can use these, they're your funds to use however you want. And I think you hit the nail on the head. Is what you just described and drew out on the board is how banks make their money. So it's what you described is allowing yourself to be your personal bank. I mean, it's all about the flow of the money. And when you've got the guarantees of the life insurance and you've got life insurance companies that are A+ rated that have been around for 160 years paying dividends, that's why we love this stuff, is because there's no risk in it to us. That's why banks own tons of cash value life insurance. And it's all about the velocity of the money, right? When you're doing the infinite banking concept. You take it out, you use it, and you put it right back in. But the whole time, the insurance policy doesn't know that there's a loan out there. It knows that the policy is collaterally assigned, but all the funds that you originally put into the policy are continuing to grow as if there was no loan out there. So it's an amazing tool. And I'll tell you this, this product's been around for, you know, a little over a decade, and different banks. There's a few different banks involved and have programs, but I'll tell you, we started our program about just over 2.5 years ago. We started at zero. Our portfolio just hit $140 million.
Nice. Love it.
2.5 years, $140 million. People love this stuff, and it allows you to use your money exactly the way you want and be your own bank. It's really a no-brainer, especially the fact that there's no fees.
And like some folks listening to this are probably like, you and Chris probably got together before this and planned this. Like, we didn't talk once before this. He just popped on. He had no idea what he was going to talk about. No idea what this show was even. We're just like, hey, come on to this show. And he just shows up. Like, so folks, like, you're hearing two different people talk about the same thing in two different ways. He's with the bank. You know, we're just teaching you how this banking system works, but the story never changes. This is what banks use. Therefore, banks love this because they have this, they understand this. But I'm going to, you know, Mike Tyson said, you know, everybody has a plan until they get punched in the face. So I got to go to left field for a second because I have so much fun doing this. IULs, Index Universal Lives. These are the hottest things on the market, says all the brokers who are making 120% commission on the deposits. Like, they love these things and they're selling them like hotcakes. It's the greatest thing since the toothpick in the financial world. Like, IULs are so freaking great for everything. There's nothing that they don't do well. I'm elaborating, folks, but like, this is kind of, if you get in the space of IULs and you do any call or any meeting with an IUL broker selling you one of these, they will make you feel like this thing is the greatest thing in whole life. All that boring old monster, that's like the freaking car that's rusted out in the driveway and doesn't even drive. That's old school. Like, this is the Ferrari. So if this is the Ferrari, Russell, someone brings you an IUL or a VUL, they can obviously get a line of credit on that, right? You'll just gladly just give them a line of credit on their IUL or VUL.
I'll be honest with you, we do not like IUL or VUL policies.
Damn.
And there's multiple reasons for that, but I like the way you kind of open that up, is because they're easy to sell. That's why they're the hottest product on the market. They're really easy to sell. But in my experience, and I actually came from the insurance business before I got into banking, and in my experience, you're not going to own an IUL for your whole life, because those mortality costs increase every year on an IUL. You're buying basically you get a savings account with a yearly renewable term policy, and it's really cheap when you're young and healthy. But as you get older and those mortality costs increase,
you're going to want to switch to a whole life where you know exactly what you're going to put into it every year, no matter what.
Yeah, absolutely. So it's just kind of, all right, I kind of seeded that one. I'm not going to lie, but like, you know, if they're the greatest vehicles ever, because Mr. Broker or, you know, whatever, Mr. Financial Advisor said it's the greatest thing, you sometimes should just take a step back and just say, well, why is it so good? And you should just say, why are all the brokers selling this when some other people like that aren't really selling anything are talking about this? Sometimes you just got to, you know, disconnect from that sales moment, because that is a sales moment. We just had Joseph, one of our guys here, sit down with an agent here. I'm not going to use any names, who was selling him an IUL, and holy crap, Joseph left that meeting being like, dude, I thought I was like buying a rocket that was going to fly me to Mars. I thought this was going to be the great, I mean, I'm joking, but that's kind of like the way this guy was selling this thing. It's like, you can't go any wrong. But yet banks won't lend on a line of credit on those. And even if you would, let's just say, Russell, let's say me, I've got 7 policies with you, I think, or what, I think maybe we only did 5 of my 7, but we got 5 policies that you're doing a line of credit on. Let's say I have an IUL, but we've got a relationship. Will you give me anything on my IUL?
Yeah, as long as you've got as long as an IUL comes with other whole life policies, or you've got an existing line that's collateralized by other whole life policies, we will accept an IUL policy because we want to accommodate clients. We know that sometimes they have different types of insurance, but the max loan to value on a universal life policy that we'll offer is 50%. And it's exactly for the reasons I just described. The increasing mortality cost, and, you know, on an IUL or a VUL, you combine a couple of years of a down market, and you combine that with the increasing mortality cost, and say the client decides not to pay their premium for a year or two, that the value of that policy is decreasing significantly.
Yeah. So, but you're only going to give me 50% of whatever the cash value is.
Yep.
And then for those of you that have looked at an IUL, you will understand that in the early years, sometimes the first, 3 years or 5, depending on how much commission the agent wanted, which is truly what it is, that determines how much cash you'll have to use. But then there's this funky little thing in the contract called a surrender charge, which then inhibits how much money you can use. So you might put in 30, you might only be able to use 5, and then they're only going to give you 2,500 of that because they're only going to give you 50%. I'm not beating up on IULs. We got a great video that we're putting the final touches on, which literally is completely neutral, says the pros and cons of whole life and IULs, gets down to the contract level, and really helps you understand it. For the first time in all of YouTube videos, there is not one other training like what we just completed. We spent about $4,000 to make this training and countless hours. Andrew's still slaving away trying to make sure that it's perfect, to show you all what is the difference, which one works for what, and which one's best for you based on actual fundamentals, numbers, and math. So that'll be coming out soon. You guys will love it. One thing I wanted to comment on is, Andy, if you're still here, you were saying this would be better with slides. Got you covered, buddy. I got lots of slides, but I just like drawing, man. Sometimes I got to get back to when I was a kid. I get to pencil things around and draw them. So Russell, what are some other things that people would need to know about these cash value lines of credit?
Some important things. And you touched it on the head. We've made the approval process as simple as possible for the borrower. I mean, you mentioned the 1-page application. It might take you 2 minutes to fill it out on your computer. All I need is that 1-page application completed and your current policy statement showing the current values of your policy in order to have you approved. I typically have people approved within 24, 48 hours with nothing crazy going on. And we're getting closing documents out the door within 5 business days. And so what I tell people is, to be safe, give yourself 2 weeks from actual approval to funding, but we're going to come in well under that 99.9% of the times. So there is an initial credit pull when we get the approval. And so the credit pull is to determine loan to value. So if your credit score is 750 plus, we'll offer you 100% loan to value on the total cash value of the policy or policies. If you're slightly below 750, above 625, we'll offer you 95% loan to value. So not a huge difference. 100% is unique to Coastal States Bank. The insurance company is not even going to let you take 100% of your cash value out on the policy. So that's something very important to point out. On the back end, once we get you set up,
we're going to give you every way under the sun to access the line of credit. So the line of credit, I don't know how many people have had a home equity line of credit against their house, but it functions very similar to a home equity line of credit. It comes with a free checking account linked to the line of credit that'll give you access to online banking with Coastal States Bank. And you can use the checking account as a pass-through to be able to move money in and out through online banking. You'll also get checks. You'll be able to write checks with no limit for the line of credit. And then for the last minute things that you need to get funds somewhere fast, we can send wires for you. And a little secret that I probably shouldn't give out is right now we're not charging fees for wires from lines of credit. So every way under the sun.
I didn't know that, man. Got to get you on that one.
Yeah. Every way under the sun to access these. Our goal is to make it as easy as possible for you to access these funds. And for us, because of the guarantees and the whole life, and because we know these A+ rated carriers, and we've got great relationships with these carriers, that's why we'll give you 100%. And we know once you set it up, you're gonna borrow against it. So you're gonna use it because it's so easy to use, and you're going to take advantage of that arbitrage. So again, because there's no fees, it's a great tool to have in your financial plan. To me, what I tell people is it's a no-brainer. If you've got $100,000 in cash value, it is a no-brainer to have available in your financial plan. Even if you don't have a use for it right away, eventually something's going to come up where you need fast money, and having that bucket of liquidity available that you can get to same day. Even so, if you take a policy loan from the insurance company, what does it take? 3 days to get a check in the mail? This
probably
to you same day. You can reach out to me. You'll get my cell phone number, and we can send a wire for you same day if you don't have a check available.
Oh man. And listen, like, here's the thing, we've known about cash value line of credits for years now. And, we never really talked about them. We just didn't fully wrap our head around. We're like, hey, we're trying to be the bank, not get the bank back in bed with us. But what I did is, I was talking to a very successful individual that I know, and we were talking, privatized banking, the infinite banking concept. He's using it, I'm using it. Literally, we're just going back and forth. The dude's like, I just bought a brand new Lamborghini Urus for my wife. And, we're talking cars. Porsches are his favorite. He's got a Panamera, and we're just using, all of it is being funded by his cash value line of credit. And then all of a sudden he starts talking about, his borrow rate. And he didn't tell me about, the bank and the cash value line of credit. He's like, yeah, I take the money from my policy. My rate is 3 or 3.25%. And I buy this and I buy that. And I'm like, whoa. I'm like, hold on a second here, Jeff. Like, his name's Jeff. And actually, if you guys will see him on my show, the Chris Naugle show, very soon, and learn who this gentleman is. And I'm like, what do you mean you're taking it from your policy at 3.25%? And he's like, yeah, I'm using my cash value line of credit. And he just said CV line LLC. And I'm like, you mean that like a home equity line of credit? He's like, yeah. He's like, all my policies, they're just funnel right into this cash value line of credit. So I'm like, wait a second. So my dumb ass is paying 5 and you're paying 3.25, and that's the only thing you did? And then I just asked the questions. Well, there's got to be a catch. Like, what's hard? It was so easy. And then another one of my clients did it. Gary, one of my favorite, best. All my clients are my favorites, but this guy is just exceptional because he just gets it. And he got a hold of you first, and he calls me up and he's like, it was so easy. It was a one call, one pay. He filled out some basic paperwork, and I got it. And I'm like, wait a second, it's already approved? He's like, yeah, I got my checks are right here. And I'm like, dude, Gary, come on, give me his number. And he sends me a text, and I called Russell, and I'm like, all right, listen, if I'm going to teach this to my audience, I have to be doing it, because I truly believe that nobody should be talking or teaching about something if they're not doing it themselves, and if they haven't fully used it to understand it. Like, I just think there's too many gurus out there talking about things that they don't even do themselves. It's like your financial advisor recommends you buy a REIT. Ask the financial advisor, can you show me the statement where you own this same REIT in your portfolio? Oh, I don't own it. Then why are you recommending that I buy? Oh, well, it's right for your risk tolerance and it's not right for mine. There's some truth to that, but you know what I mean? It's just like, when I was an advisor, I didn't always recommend things that I did myself. I might have even done something totally different than what the company told me to recommend. And I hated myself for it after I did it, but that's just the way it was. Walk into any bank. Nope. Again, Russell, got to apologize before I say it. Walk into any bank, go into Bank of America, and take all your money, literally just any money you got, just take it out of whatever banks you got, just take it all in there and say, all right, I'd like to meet with the premier banking agent or the premier banking manager. Oh yeah, I want to deposit a lot of money with this bank. And they're just going to rush around. Can I get you a coffee? Would you like an umbrella? We have suckers. They say dum-dums on them, but we can give you any flavor you want. So you're like, no, save the suckers for some sucker. But yeah, just get me in this meeting. Great. I'll take a coffee, no cream. You sit down and say, listen, I've got a briefcase full of money and I'm trying to find a bank to put this with, but I've been unsuccessful in finding a bank I really like. And the bank, the premier person says, oh, well, we're one of the biggest banks and this and that. We've got this service, that service. Every time you come in, we'll give you coffee and donuts and, whatever else you want. You're like, oh, that's cool. I love all that. But listen, here's where the other banks have failed me. So this is all I need. I'm such a simple guy. All I want is with all my money, I want you to put my money in the exact same place this bank puts its money. Can you do that? That's all I want.
No,
Russell, will the bank be able to help you?
No, the bank will not be able to help you.
That makes absolutely no effing sense. That the bank can't and won't put your money the same place the bank puts their tier one capital. It is a broken system. But can we use banks in our favor if we know how to play the game? Yeah, we are right now. That's what Russell's here for. I beat up on banks every day, but I'm using one because, hey, math doesn't lie. You guys saw the math. That's pretty sweet. I just increased my spread, my arbitrage for just meeting one awesome human being, Russell, right here and working with him. So that's how this works, folks. And literally, if any of you have policies already with the money multiplier, or you have policies not with the money multiplier, you need to get on the phone with them. Now, Russell, there are some minimums. I know we kind of hit it, but let's just hit it one more time. What are the minimums to work with Coastal States Bank for cash value?
Yeah, so our minimum line amount is 100,000, and if you'll give me a second, I'll go through the tiered rates again, so everybody knows what they are and is aware. So, we currently from 100,000 to 250,000 will offer Wall Street Journal Prime minus 50 basis points. Then from 250 to $1 million, we'll offer Wall Street Journal Prime minus 1%, and from $1 million and up, we'll offer Wall Street Journal Prime minus 1.25%. All with a floor rate of 3.25. So prime currently equals 3.25. So everybody, whether you got a $100,000 line or $10 million line is borrowing at an effective rate of 3.25 today. But let's say, for example, I think I used it before, a $500,000 line. That means that prime would have to climb above 4.25 for you to move off of our floor rate of 3.25. And I'll be honest with you, we do have fixed rate options that we haven't really marketed. We've gotten them approved. I don't recommend them. They're tiered just like our variable rate options, but they're going to be higher. And I'll tell you what they are. For over $1 million, it'll be 3.9%. For 250 to $1 million, it's going to be 4%, and for 100 to 250, it's going to be 4.10%. So I recommend taking advantage of the lower variable rates with the aggressive spreads. But for those people that are concerned about interest rates skyrocketing here pretty soon, we do have fixed rate options. I'll throw that out there. We don't really advertise them, like I said, because they're not that attractive just with where rates are today. And again, I don't want to get too far down in the weeds. I would expect interest rates to start to tick up a little bit 2022 towards the end of 2022. But, with the environment that we're in, can't raise rates that fast. I'll just say that. That's my opinion. So I recommend taking advantage of the aggressive rate spreads we offer on the variable rates.
Yeah, and I will double down just with all my knowledge, and believe me, I'm a nerd when it comes to this stuff. If the government raises rates too fast, they will collapse the entire system. They know this. Follow what Japan did. They got themselves into a very same predicament, or actually US is in the same predicament Japan was. They couldn't raise rates. They were in stagflation because they could not raise rates. They literally backed themselves into a corner. The US has done the same thing. And I don't know what the answer is, how they're going to get out of it, but you are going to be in an incredibly low interest rate cycle for quite some time. And it'll just be catapulted when the whole stock market crashes and burns, which all of you REIT lovers or stock lovers, beware. if you weren't on the 3-day to hear from Harry Dent Jr., one of the leading world economists, who also resonated all the other economists that, you know, would like him or hate him, they're all saying the same thing, folks. These are the people that literally, like, usually they have glasses, they never have sex because they don't, like, I don't know, like, that's what he said. They said, you know, economists are a rare breed, but these are the people that the world listens to predict patterns and what's going to happen. And he literally outright said the markets are going to collapse. He even said it could be as much as 85%, but he's not the only one. Jim Rickards is saying the same thing. Read his books. Like, he's famous author. Like, all of them are pointing to the same thing. And that is, and actually you just heard the government kind of say that a little bit. They're hinting like there's something coming. The storm is coming. So just beware, folks. Like, what we're talking about, this stupid, boring whole life thing we're talking about, that's guaranteed. Your REITs, your stocks, your crypto, not guaranteed. I love that you're making money, and kudos to you. Pat yourself on the butt, but just remember Warren Buffett's 3 rules. Buy low, sell, keyword, sell high, and then don't lose money. Don't buy high, sell low, and lose money, which is what the average person does. I hate to say it, and everybody's like, no, we don't do that. I'll give it some time, and we'll prove that yet again, just like we proved it in 2008, like we proved it in the dot-com crash. Shall I keep going? Because we just don't have time for that. Stop following the herd and doing what everybody else does. Get on your own path, get control of your money, and be your own darn bank. And all of a sudden, things just simply make sense. So Russell, and it's been awesome having you on, but I got another favor. We got way too many questions. We got 25 questions, but while I'm reading some of these questions, I'll answer the ones that I can. And if you could just chime in, could you just make sure in the chat, could you just put all of your contact information for those that would want to get a hold of you? And
yes, I can do that.
That would be great. So I'm going to start going. So Shauna said, when the loan starts, is it based off the day's cash value or based on the 5-year term of the policy? Does the bank take into consideration that you have incoming payments over the 5 years? So what Sean is basically saying is, like, when you get this line of credit, what is the line based on? Is it based on that day's cash value, or is it based on the end of the year cash value? And the next year, when I put an additional premium deposit in, like, am I still locked into last year's numbers? So I'll let you hit that one.
Yeah, that's a great question. So we don't want to use the annual. It really depends on the insurance company and how they credit the cash value throughout the year. But the annual statement's not what we're looking for. We're looking for the most current, and they all call them something different. We'll look for a policy verification letter from Mass Mutual, or Guardian has a policy status report. Penn Mutual has a policy summary. Whatever the current shows, the current values as of that day is what you're going to want to use. And that's what we'll use to originate the line. And then we offer line increases at no charge once a year for clients. It's not an automatic thing. It's you'll have to request that yourself. And what you'll do is you'll see if you end up applying and setting up the line, it'll be the same one-page application to request the line increase. There's a box in the top left. You just check the box for line increase, write in max available. Send that in. That'll be my trigger to reach out to the insurance companies to get updated statements for your policies. And then it's a 2-page loan modification document that we send out via DocuSign to increase the line. And that brings me to another point, is we close all of these lines of credit via DocuSign. So we want to make it as easy as possible on the borrower to set up the line and get access to it as quickly as possible.
Yeah, that's amazing. All right. So with that, I'm just answering some people are like, how do I set up one of these awesome, privatized banks? Well, that's all we do, folks, at the Money Multiplier. We do nothing else besides banking and set these up. So we certainly can help, but we do ask. We've got kind of hit some things high end, and I got some slides for Andy that I want to put up in a second just to kind of get it a little closer so you guys understand it. But that's all we do. We do require, it's a prerequisite that you watch a 90-minute video or a 10-part video series, which you can find at chrisnaugle.com. So I'll put it in the chat. So it'll be right under Russell's, chrisnaugle.com. And you can just go there. The 90-minute video will pop up. You can get both of my books for free. Mapping Out the Millionaire Mystery teaches you about this. And hey, if you guys want to get all the money back for all the cars you're ever going to buy, drive, and own, this booklet, 63 pages, super big writing, lots of graphics and pictures, teaches you how to get all the money back for all the cars you ever buy, drive, and own. And I think I'm going to have to rewrite that book, because I'm going to rewrite that book showing the actual numbers using a cash value line of credit. And then you'll look at the numbers and be like, that can't be real, but it is. So that's how we do it. And we're trying to keep up with the chats here. They're coming in hot and heavy. Russell put his number and his email, but I bet you guys are like, oh, where's his number and email? Because it was gone. It vanished because of the chats coming in. All right. So this one is, oh, I love this question. Juan said, are policy loans reported to your credit? Like if I borrow from a bank, it hits my credit score. Like, are these reported? I love this.
Sorry, can you repeat that, Chris?
Sure. Are the policy loans, well, let's not say the policy loans, I'm sorry. Are the cash value lines of credit, when we use it, are they reported to our credit?
Yes. So that's a very important point.
Yes.
So for individual borrowers, there's two ways to set it up. If you don't want the line of credit to be reported to the credit bureau and show up on your credit report, you're going to want to designate the line to be for a business purpose. So you'll see on the application that you'll check the box for business purpose, and it's going to ask you for a type of business you expect to use some or all the funds in. We just have to designate a type of business. Most of my clients are designating it as real estate because most of my clients are using it to invest in different real estate investments right now. But you got to designate it, but they're your funds to use how you choose to use them. It's your cash secured loans. So they're your funds.
So we have an option. We can either do the line of credit and use it for business like copy machines, real estate, and all that good stuff, and then not report it to credit, or you can just do it the old way and just say, hey, report all of this to my credit report, because they just love that stuff.
Right.
Sorry,
Right.
I'm just smiling.
Exactly.
Like,
But it really depends on the preference. I mean, so if you're paying off the balance pretty quickly and you're not carrying a big balance on the line of credit, it could help your credit score if you want to try and bump up your credit score a little bit. So it's something to think about.
That's true. I never thought about that.
Yeah, most of my clients, I'll tell you, are designated for a business purpose. They want it to function kind of like a policy loan. It won't show up on your credit report.
Awesome. Awesome. All right. This next one's another good question. Oh, also, Juan, I just want to go one step further. If you take the money, like the loan from the insurance company, nothing in that system is ever reported to anyone. You don't get 1099s at the end of the year. The loans never get reported. It's called privatized banking. Okay. It's not a made up number. It's private. Imagine that. Something that the bank doesn't ask for every transaction over $600 on. Oh, wow. They never, ever ask you anything that you do in your private banking, ever. No reporting at the end of the year. All the money you make inside the policy. If it's structured properly and it's not a MEC, tax free. Oh, and I forgot to mention, in most states, these policies are protected against judgments and liens. So you in a risky business, you a surgeon, an anesthesiologist, where you carry high levels of risk and make a lot of money, this isn't such a bad place to put your money because it is protected against judgments and liens. And then we never hit the fun part. Someday when we graduate, like no matter how much money we take out of our policy, no matter how much we use, someday when we graduate, there's money paid to our beneficiaries. Magic. It's self-completing. Like the Rockefellers. Why do you think they get wealthier each generation? It's because they die. Oh, well, if they die, how does that mean they get wealthier? Because an insurance company writes a ginormous check to the trust that funds the next generation to keep growing the family legacy. The banking institutions, whatever the hell they do, a lot of bad things these days, I would assume. But do you get it? Like this is just how it works.
Yeah, I think you hit the nail on the head. One thing we haven't really talked about are the tax benefits of owning whole life insurance.
Oh yeah, no, I didn't hit that.
I mean, that increases the
rate of return on the guaranteed rate of return on the policy.
Oh, dude, I love that you just hit
it up
that.
Right. And one of the things that I'm not a CPA, so I'm not allowed to give tax advice, but if you designate the line for a business purpose, it's on you to account for how you use the funds for that business purpose. But if you get with your CPA and say you use it for a real estate investment, you account for how you use the funds properly, the interest expense on that portion of the funds can be tax deductible.
Yep. So folks, when I do this copy machine, I'm going to lend the money, whatever the price of the copier is, it's called $8,000. I'm going to lend that to Money School, and I'm going to do a promissory note. It could be a one-page promissory note. I, Chris Naugle, lend Money School $8,000 at a rate of 6% for X amount of 5 years for the term of the lease. And the payments are going to be $170. That just literally goes in a file. That's it. And then I do that. Now, that money that pays back to me is tax deductible to Money School. That's 6% interest. And then, so I'm making 6, and I'm just using simple numbers. This is tax deductible to Money School, my company. That 6% then is paid to me. That 6% is taxable to me. But then what I do is I got to give 3.25% back to that greedy Coastal States Bank, just joking, that Coastal States Bank, that if you have a good accountant or know how to do this, is a tax deduction as well. It is an interest expense. So I take this, I subtract this. Yes, I pay tax on the difference. But my accountant's pretty good and figures out somehow where like that happens. You guys should have been at the 3-day to learn from Solomon how that actually works, because at the end of the day, there's not a whole lot of taxes. Pretty awesome. All right, so let's see. We got to get through these. Can IBC be implemented on someone that lives paycheck to paycheck? And if so, hi. Charlie, I'll get right back to that. That one's just a longer answer. Eve, to confirm my thought, if a loan is on our whole life policy, we would need to pay it back to get cash value line of credit, right? Oh, no. Yeah, why don't you just use mine, Russell? Tell them like what I had. How much? God, I had over 100,000 in loans on my policy.
Yeah, I think you had around over 100,000 in loans. So a lot of what I do is refinancing policy loans. So if you have at least $100,000 in cash value and you have a policy loan on your policy, there is no reason why you shouldn't be reaching out to me right now. I will refinance that policy loan all day long. We'll pay it off as a part of closing, and you'll be able to draw whatever's available on top of that from the line of credit.
There you go. Like I didn't pay my loans back, Eve. He paid them back. So I literally, just like your house, right? If you got a mortgage or a higher line of credit that's like 5% and you're like, hey, I can refinance you at 3. Like you're going to do that because, hey, why wouldn't you save that? That's what he did. I literally went from paying 5% down to paying 3.25 like that. So great question. Great question. Eric said, how does it all get set up? I'm in the process of setting up my first policy and I have no idea what to do after that. So Eric, if you're setting your first policy up with the money multiplier, the next step when you're approved and you make your first deposit is we're shipping you off to our mapping team. Totally free. We have an entire team with an entire tool system that is going to build out your map of how you want to use this. When you talk to the mapping team, what you're going to want to do is say, hey, just so you know, I'm using a cash value line of credit, and they will know instantly. They will just change your map to reflect, instead of 5, they'll reflect at 3.25 through Coastal States Bank. Oh, and also a lot of you are thinking, well, what if I don't have a policy that has 100,000? Now, I don't mean to do this, Russell, like they started 100, but we have a bank that actually will start at 25 if you want that. Russell's definitely the easiest and the best to deal with and most knowledgeable, but the other banks, if you need to for lower policies or lower cash values, we do have solutions for that as well. And Russell, you guys have to be paying us something. These people listening to this, they got to be thinking, oh, there's some kickback. Are you writing checks to me or Money School for this?
No, not at all. In fact, Chris, I think we met like 2 months ago, maybe. I mean, no relationship at all, just met. And Chris said, I've got to try this. And we set it up for Chris. And I think you would
say that it was a pretty smooth, easy process.
Yeah. Like they're not giving us anything to have them on here. Listen, folks, the reason Russell's here, the reason we're talking about it is I'm always trying to find ways to make you more money. There's no hidden agenda here, folks. Like they're not paying me to be on here. They're not paying me every time you set up a line of credit. That wouldn't be bad, but that's just not the way it works. They're on here because you need to know this. This is how I'm making more money and how my team is making more money. So why wouldn't I share that with you? Like, why would I ever hold something? If I had the cure for cancer, I wouldn't hold it or try to profit. I would just give it, because in the universe, the universal law is if you give, you get. I am living proof. You guys listen to my story, watch the 90-minute video, see where my life used to be. See how many times I rode the financial hamster wheel just playing the traditional game. I've crashed and burned enough times to make all of you cry for me. Don't. I then figured it out and I learned that the secret is you give first. You give first. And no matter what, the universe can do nothing other than give back to you. I mean, you've heard it in the Bible. You've heard it in Think and Grow Rich. You've heard Zig Ziglar talk about it. Like, this isn't made up hocus pocus stuff. Go to the top of a building and jump and let me know if you can beat gravity, a law. If you can't, you're a pancake. You're dead. Sorry. Maybe you live, but you're broken. Okay. This law of giving is a universal law. It can't be changed. It can't be altered, and it cannot ever be beat. If you just do that, you get. This is living proof, folks. I'm here giving to you. Yes. Will some of you start policies? Yes. Will we make commissions? Yes. Very small commissions. Per 10,000 in deposit into your banking policy, we make roughly about $387 to $487. That's the range. Do you think that is getting you excited? No. And it doesn't get us excited, but we do that for thousands of people. So do you think we get excited about making $387 on 3,000 people? Do the math. You guys can figure that out. Yeah, it's pretty sweet. It pays for a big office. It pays for, lots of staff, and it pays for us to do some really cool things like put vinyl on the walls to make it more appealing and cool looking for you. Sean said, I'm looking at my policy and I have no idea if I qualify. How do I know if I qualify? Sean, really easy. Call Russell.
Yep.
There you go.
You can call me.
Peter said,
to talk through it with you. And Chris, along the lines of what you just said, the reason why Coastal States Bank launched this product, the reason why I was so excited to get involved with the product is because this is one of those deals where it's a win-win-win for everybody involved.
I agree.
And for the bank, because we're collecting, we got zero risk loan out there that we're collecting 3.25% interest on. It's great for the agent, the life insurance agent, because it protects his book of business. Because a lot of times what people do when they take out policy loans is they'll let that loan accrue in their policy and they won't pay it back, and they'll end up surrendering the policy. So it protects the agent's book of business, and the insurance company's happy because the money's back in their general fund, invested the way it should be invested. So everybody's winning in this scenario, and that's the kind of scenario that I wanted to sign on to. So that's how I got involved in this.
Absolutely. Peter said, what are the tax implications when you pay yourself back versus paying another lease company? So I kind of already covered that, Peter. If you want, if I didn't hit it the way you want, why don't you just send me send another question in, or hit me up with just a private DM on social media and I'll get that one. But I think I kind of hit that. It's tax deductible for my company. It's taxable to me, but then I take a tax deduction on what I pay Coastal States Bank. Simple math. Your CPA could do that for you. I can't give tax advice either, but I just get advice from CPAs that know what they're doing. Do we contact Russell for the policy? No, Russell, you don't write policies, do you?
No, I don't. I'm not affiliated with any insurance company.
Yeah. Perfect. So you contact Russell to set the CV line of credit, the cash value, that's CV line of credit, because that gets Thomas's question right out of the way. And he'll set that up. So if you're working with Gabby, Stephen, Devin, Joseph, myself, setting up a policy with the money multiplier, we'll get you all set up there, get you into the mapping when you're all approved, and then we'll basically help you get hooked up with Russell to do what you need to do to get the cash value line of credit done. All right. Mark said, do you loan against a portfolio of precious metals? If so, is there any difference on the terms? That's an interesting question.
I'm not sure I understand what's being asked there, to be honest.
So how I would anticipate, or how I would articulate this question is, you'll lend against cash value in a policy. Will you also lend against gold or silver or precious metals?
I mean, yeah, I think I would say that would probably be like, any other margin loan that's out there. I don't personally do that. I think we would take a look at it and possibly do some type of margin loan against it. But again, 100% of my time is kept up with these cash value loans. I mean, I'm very, very busy with cash value loans. So I could refer that to another banker I work with. But yeah, I mean, it's a possibility. We're always looking at different things to loan against. But the reason why we love the cash value loans is because the guarantees. We know these insurance companies, we can give you 100% of the cash value because we know the money's going to be there. Once it's in the policy, the money is there and it's going to continue to grow, period.
Mm-hmm. No ifs, ands, or buts about that one, folks. So Tricia said, interest in, I love this. Trisha's probably like, wait a second, this is too good to be true. She said, interest and dividends are paid based on the 30,000, even though you took out the 25. So here's what she's doing. She's wait, my bank, if I put 30 in and I take 25 out, my bank's only paying me interest on the 5,000 left, but you crazy bastards are paying it on the full 30. Yeah, the insurance companies are pretty crazy because they're doing that. Actually, they've just figured out how to do it. It's not very complicated. So Trisha, we just put up a thing. Watch the 90-minute video in the chat and then book a call, because the 90-minute video will make it crystal clear how this works. That's how I learned this, by watching a 90-minute video. And then from there, then I booked a call with Russell after I was 7 policies deep, and he hooked me up with this. So how do my wife and I set up an appointment? We are in Florida, would like to get started before the rates drop. Yeah, that is November 1st. So, and then a bunch of details. So B&B right there, buddy. So just copy and paste that to, your computer or your phone, or write down that link. So the first one is a 90-minute video. Maybe you've already watched it. If you do, just go right to the call. So the Once Hub right there, you just click that and it will send you our calendar and you can get a call. And then once you get, the policy going, get a hold of Russell, which his number is right there, and then have yourself get started on setting up that cash value line of credit. I can't believe the amount of chats. I'm just trying to find where you posted your stuff, Russell. Holy crap. That was like 50 chats ago. So here's Russell's information. I'm trying to keep up, folks, but I'm trying to also get your questions answered. So it's a double-edged sword here. All right. Juan said, how long after the medical exam does it take to be approved? Well, just understand right now, the insurance companies are obviously pretty backed up because everybody's rushing to get that 4% guarantee locked in before October 23rd or November 1st, depending on the company. So I'd say be safe, 45. In the long side, if you got some medical issues and some APSs, 60 days. But it doesn't matter if you go past November 1st. Here's the deal. You just have to have the application sent or started and in by October 23rd or November 1st to lock in. Then it doesn't matter if your policy is not issued till January, you're still getting the 4% guarantee. So hopefully that helped a little bit for you. Cash value line of credit, you got it, Thomas. Liz said, what companies do you work with? Guardian, Mass, One America. Wow, Liz, you've been paying attention. Yes, all but Guardian. We don't use Guardian yet. They're a great company. If you're working with somebody that's doing a Guardian banking policy, good for you. Just understand Guardian is a direct recognition company. So you are going to need to work with Russell in order to get that compounding effect on the full value, even when you take loans. We only use non-direct recognition companies, Mass Mutual, Lafayette, and One America, where they pay dividends and interest, whether the money is in there or whether you took it all out in loans. But with the cash value line of credit, it's the best thing. It doesn't matter if it's direct or non-direct because the bank is taking that on. Like your money never leaves your account and there's no loans by the insurance company. So it's a beautiful thing. I would say probably in the next couple of months after the 7702 kicks in, you will see us using Guardian in rare occasions. Stacy said, what are your tax implications when using for business? Can I make regular deposits to the account, not part of a loan payment? Can the whole life protect my business's line of credit? What bank does Russell work for? Coastal States Bank is the bank that Russell works for. Okay, get that one out of the way. My computer just froze. There it goes. But Stacey, you got a lot of questions. Number one, I can't give tax advice. You'd have to ask your CPA how he would take deductions. But can you use this in your company? Yes. I'll give you an example. We have a big development company that we're setting one up for. It would be considered a COLI, company-owned life insurance. We took one of the partners. We're doing a policy on him and doing another policy on the other partner. So both partners in the company are getting a policy. And that policy is going to be owned by the corporation and funded by the corporation. So what the company's doing is they've got a bank account which has lots of cash in it. They're just going to basically carve out some of their working capital that they don't use every day to pay bills and move it down to this vehicle. Then what they're going to do is when they buy real estate, they're going to only use this vehicle, their private bank, to then fund the real estate so they get the uninterrupted compound interest. They're not going to use this vehicle to pay for, utility bills and, all that. They're going to use this to pay maybe property taxes, buying additional equipment, buying more real estate so that they can do this. So you can do it the same way. Hopefully that answers all those questions.
Hey, Chris, you bring up a great point. We will do business. We can take corporate-owned policies as collateral. It's different one-page application. It's actually easier to fill out than the individually owned one-page application. But we do have, it's a little bit different process in the fact that we do have to underwrite the business since it's a commercial loan. So we'll ask for the documentation of the business. Obviously, if it's not just a single member, we'll need the articles of incorporation, the certificate of existence, just the basic business documents. And typically we're going to ask for 2 years of tax returns just to make sure it's a viable business. But that's all we need. And same approval time and same approval, same closing time.
Awesome. Let's see. We already hit that one. What is the minimum? It's 100,000 to work with Coastal States Bank. We have one bank that will go down as low as 25. Anything less than 25, we're just borrowing from the insurance company. So Stacy again said, you mentioned earlier that the rate of 4% could change this month. No could, is. Like no ifs, ands, or buts. The 4% guarantee is gone at the end of, at the end of this month, gone. Like never again will, well, I shouldn't say never again, but it's gone. 7702 is the rule that the government passed. It's allowing insurance companies to reduce their guaranteed interest rate. I know like one of our main providers is going to 3.75, another one's going to 2, another one's 3.25. We haven't seen illustration. I've seen illustrations from one, and it's going to sound really weird. Okay. And you're not going to understand this, but we will get into explaining this when we actually wrap our head around it. The numbers, the cash values with this one company, even though their interest rate dropped 75 basis points, the cash value is more. There's a lot of reasons. And all I can say is the government stepped into this world in 1988. Oil tycoons were putting billions of dollars through whole life policies, and they were like shoving $1 billion in, putting a really low death benefit. And nobody ever regulated any of this. The IRS was just like, we don't care. We use these too. So just carry on. And then all of a sudden you got some news published and everything else. And the government came in and said, whoa, hold on a second. If you're going to put in $1 million, we're going to set a rule that in the first 7 years, you have to have X amount of death benefit. And that's called the MEC 7 pay rule, modified endowment contract. So they put this rule in. So in 1988, the music stopped, like your favorite song. And now all of a sudden there was rules that we need X amount of death benefit for X amount of cash being put into these vehicles, which really hurt the wealthy, because now all of a sudden, if they wanted to put a bunch of money into this contract, they had to have a lot of death benefit, which that death benefit was expensive. So it took away their returns or hurt their efficiency. So then we've gotten smart and we started using term insurance instead of whole life and base policy, because term was cheaper. So now we've brought that cost down. But now with this new rule, it's like partying like it's 1987 again. The MEC rules are completely changing. The amounts we can put into these new contracts, I don't know. I'm not going to say it's like to the moon, but it's going to be good. So people that want to put a bunch of money into these with really low death benefits, you're going to love 7702.
Yeah, if you're using it as a bank, it's a great rule change.
Yeah, I think what's going to happen, and I'm not saying anyone should delay like getting your 4% locked in, because listen, I'm rushing to get a 4% locked in. So is Steven, so is Devin. Everybody on our team is rushing to get their policy set up because I want a 4%, right? We know how they work and they're freaking good. But when it goes down, Russell just said it, I'm kind of saying it, I have a feeling, okay, this is speculating, but I have a feeling it's going to be pretty freaking awesome. In other words, I have a feeling we're going to crack a bottle of champagne here and celebrate, because all of a sudden it's going to open up a whole new reality of how we do business as a company and how we teach our clients to use this that we have not seen since 1988. But that's speculating. That's like me saying the stock market's going to go up another 50% by the end of the year. You should just say I'm a liar if I ever tell you that. All right, if I borrowed money from MassMutual 5% recently, can I get yeah, we already went over that, Peter. So they will refinance your MassMutual loan. Thomas said the minimum cash with Russell's company, it's 100,000, but like I said, we have another company that will start at 25. Juan said, does bankruptcies in your credit report affect the approval process? Yeah, I mean, it would drop your rate, but wherever your rate is, you're just going to maybe not have 100% access to all your cash value. It might drop a little bit from there and your rate could go up. Oh, this is a good question. Jameson, is the 3.25% simple interest? Yes, it is. Simple interest, and the payments are interest only. And that's the key. When I tell people is from a policyholder standpoint, it is in your best interest to just cash flow the interest on these loans. The low interest rate, cash flow the interest, and that keeps the loan from growing and eating up the cash value of your policy, right? Mm-hmm. And that's what typically happens when people take out a policy loan. It feels good because they don't have to pay the interest. They can accrue it in the policy. But what ends up happening is that loan keeps ballooning and ballooning and ballooning because of the law of compounding. And when they get up against a wall in their policy, it's a lose-lose situation for everybody, because they're not going to pay that loan off. Typically, they're just going to surrender the policy, and then there's huge tax consequences of that. So that's why the line of credit comes in. It's a great tool because it's an interest-only payment. You cash flow the interest every year. The loan stays the same. It protects your life insurance and keeps it growing for you. And there is no risk of surrender or lapse down the road. Man, great answer. And somebody was just saying, should I pay the interest back every year? Like referring to the insurance company. Listen, if you owned a bank or you owned a grocery store, would you steal from your bank? Would you steal from your grocery store every day? Would you just go in and take all your groceries and never pay for them? Would you go into your bank and just take loans and just say, hey, I own the bank, I'm not going to pay it back? If that's you, don't do this. please, this is not a good fit for you because you are a thief. You would steal from your own business. You would steal from your own bank. Don't do this. We teach people how to be honest bankers. If you own a bank, treat your money the same as you would treat the bank's money. Never, ever steal the peas. That's straight from Nelson Nash's book. Love that. Aaron was asking, blah, 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 blah. He's going to figure out a policy. It's got cash value as long as he hits the minimums. Can I get a hold of Russell's bank? And he writes me, he's not writing you a policy. He's writing you a cash value line of credit on the policy. Yeah, absolutely. So how much money do I have access to? So whatever your cash value is, so go log into whatever company we got you with, Mass Mutual, Lafayette, One America, and just look, it'll say cash value, surrender value. That's how much money in year one you'll have access to. Next year, when you put more money in, they will review it again. You'll send them a new report. It'll reset and it'll keep going up. If for some reason, like you have cash value and you do like an odd dump in, you overfund your policy, send them the new one. How many times will you look at a policy's cash value in a given year without a cost?
How many times will we look at the policy's cash value in a given year?
Let's say somebody has a policy, they set up a line of credit, they got 100 grand, but then they dump 50 grand into their policies PUA. So now they've got 145,000, but it's the same year. Would you guys review that and maybe increase their line?
Yeah, so we offer it once a year at no charge. Now, if you want additional line increases more than once a year, we'll do it, but we'll do it for a $500 fee each time, and we can roll that into the loan. So, I mean, for a significant line increase, $100,000, $200,000, a $500 fee rolled into the loan is nothing in my mind.
Absolutely. Wes had an interesting question I'm going to answer offline, but he said, so I got 100 grand in the IBC. I take the loan, or I take the money from the cash value line of credit. I invested in the REIT. Then what I do is I get the line of credit, the margin line on the REIT, and I take that money and I lend that money out and as a private lender at 12%. Isn't that a great way to compound 100,000 at 3 times? Absolutely. Just one thing that scared me in that, REITs. They're scary. If you really understand them and you look at them, you should really look at the past, like go back and see what happened to REITs, you know, and how they perform. Don't look at the average rate of return. If any of you have been around this campfire, I've explained actual versus average rates of return. That should have woke you up. If you need to, go back and watch that because you need to see it again. So actual versus average rates of return are very different. So does this provide, oh yeah, is there any states you don't do this in?
No, this is a national offering. So we'll loan to anybody in the country.
Let's see. Lynette said, we have a line of credit at the bank. Would it be beneficial to switch to this one? Lynette, that's kind of a loaded question. It's one that would come with many different questions. I mean, what is your rate on your line of credit? What is it attached to? Do you have a banking policy that has 100,000 in cash value? And, you know, if the math pencils right, like if 3.25 is less than what the bank is charging you on your line, absolutely, definitely. Yeah. But again, you know, I think there might be some things we'd have to flush out there with that question.
Yeah, you can email me and we can take a look at it for you.
Yeah, exactly. Glenn, you were asking, how do we set these up? I'm just going to send you over. There's a 90-minute prerequisite video that you have got to watch. And then after that, you set up a call. So I gave you our calendar to set up the call. What is the minimum amount to start a policy? 10 times your age. I'm 44 years old. So 44 times 10 is 440 a month. That's the bare minimum for people that are 30 to 60. If you're under 30 or over 60, do your age times 15. That'll get you your minimums. Let's see, trying to get to the bottom. These are insane. What is the minimum? No, we already did that one. Sorry about that. Answer live. Anonymous said, can you depreciate the copy machine like a farmer depreciates his tractor? Of course you can. Like it's business equipment. You can depreciate the hell out of that. Good question. Beautiful. Boy, look at that. That person's like, so I get all the money back for it, but can I depreciate it? Oh yeah.
The question is, can you cost segregate?
There you go. Yeah, thank you. Thank you. Let's get out of the depreciate and talk about cost segregation. Get yourself a good CPA and I don't know what you can't depreciate.
Right.
Now, G-Wagon out there that I own, I just appreciated the hell out of that thing this year because I needed a tax deduction. I never knew that existed. I think it's like 168 something. Whatever, leave that to the accountants. Can I combine my IBC policies to read? Yeah, oh, absolutely. So Sonia, and I know Sonia, like definitely, like we'll take your policies like I did. I had 7. I used 5 of them and I combined them to basically one line of credit. So you might have one that's 20 grand, one that's 30, put them together and like, that'll get you to the level that you need to be at. Yes, she definitely would be a great one to use this. Can you get a loan on an indexed annuity? We already hit that. So you must've been sleeping during that one. Sorry, got to be there. The answer is Oh, an indexed annuity. Oh my God, I went to IUL. Do you guys do lines of credit on indexed annuities?
That's a good question.
It is. I'm sorry, Lisa.
No, that's a good question. I get asked that question a lot. Our program is specifically designed for whole life insurance. Now, we'll accept an IUL policy at 50% loan to value as long as it comes with a whole life insurance policy. Annuities are a different ball game, and here's the reason why. Is if we ever get into a situation where there's a default or we want out from under the loan, it's not like a life insurance policy where we can reach out to the insurance company and switch the balance on the line and have the insurance company pay us out and switch the balance to a policy loan on your policy. Because we don't ever want to be in the business of surrendering people's policies. We want to avoid that at all costs. Well, if we collateralize an annuity and we get into a default situation, the only option is surrendering that contract if we want to get paid out. And we just don't want to be in the business of doing that. So the answer.
Absolutely. Charlie said, that's the one. I got to get back to you, Charlie. So 2 payments. So Unanimous said, so 2 payments, one for the cash value line of credit at 3.25% or wherever you come in, and one to repay the IBC loan. No. You're looking at 2 different things. Increase it. Yeah. So you're caught up in the fact that you think you're borrowing from the insurance company. Here, we're no longer doing this. We're borrowing from the bank, which in this case is coastal states. So when you take the loan, when you write the check, right? Let's use my example. When I write a check for that copy machine, $8,800 is basically coming out of my line of credit through Coastal States Bank. So $8,800 then goes over and I buy my copy machine. Sorry, the drawing's not that great, but that's my copy machine. Then what I do is they're going to start charging me interest on that $8,800 that I took. So what I'm doing is I'm charging myself $170. Let's get rid of some of this. Okay. I'm charging $170 a month, which is the same exact amount the copy machine's leasing company would have charged me, dollar for dollar. Then I take that $170 and I literally just send it back to Russell. When I first set my lines of credit, I had a bunch of repayments going back to my life insurance loans. Like every month I think, what was it? $1,900, $1,900 a month was going back to repay the loans on my life policy. So on my loans with my life policy. So all I did is I changed the direction of where they went. I just changed the bill pay. Or actually you guys set it up automated. They even make it easier. Unlike how I did it before, I just set it up with him where they just drew the money right out of the account. So I just set it up. So when I do this transaction, I will take the $1,900, I will call Russell and say, Russell, we got one more we got to add. And I will add $170 a month to my repayment to the line of credit. Because every dollar of this, just remember, every dollar minus the interest, every dollar of my recaptures is money I have to use the next day. So it's not like I'm losing money. Like a lot of people want to think, oh, that's an expense. That's just because that's what you've been doing your whole life. You've been spending your entire life giving up money for all your expenses and your debts to somebody else. Imagine if all the money you gave away to all the debtors in your life, imagine if all that money went back into your bank account, where would you be? Well, I don't know. Ibiza sounds like a really nice place right now. But anyway, you get the drift. Like that's how it works.
Yep.
All right. Joseph, Russell, do I get a 1099? Oh yeah, great question. So does he get a 1099 at the end of the year?
Actually, that's a good question. We don't provide tax documents. So we can provide you at the end of the year if you want a loan summary showing the transaction
History on the line of credit, we can absolutely provide that for you, but we're not going to provide tax documents.
Perfect. All right. So you're just going to have to track it yourself and just look at the statements. They give really good every month. Every month I get a statement.
Yeah, you'll get a monthly statement. It'll show the balance outstanding, the interest rate paid. It'll break it down for you. And then if you really want like the loan summary for a month or a year or 6 months, you can reach out to me and I can send you a loan summary breakdown of all the transactions.
Perfect. Dexter's asking, is there a calendar link? If you could just put your info in one more time, I swear to God, your information has vanished. I've been trying to keep up on it. I just can't. I'm gonna have to go back 100 chats just to get it. Yes, this is recorded. Let's see. I have a policy I want to replace with the new IBC policy, but I only have 20 grand in cash value. Can someone help me? Tabitha, absolutely. I just put the link up. Get on the phone with us. We have this happen all the time. People will have like an old UL policy or an old BUL policy that has cash value. They're like, I want out of that. I want into one of these ones that's designed for banking. It's called a 1035 exchange. 100% of your cash value can be brought over tax-free to this new contract built like what I just showed you, but you got to watch the video and set up a call with us. That's a great question, Tabitha. Liz said, I meant, Russell, which company? Already have Guardian policy setting up Lafayette, One America, Mass. Yeah. So Liz, you absolutely need to talk to Russell. You got to get in with him. He just put his information up again. I'm going to save it. Shauna's going to repost the 90-minute video to book a call with us. So she'll give you the video, which is a prerequisite to a call with me, Stephen, Gabby, Joseph, or Devin, one of our team members, or Brent, but you have to watch the video first. And then right after that, it says in bold letters, you book a call with us. So Russell is easier. Like you just call him. Unfortunately, we used to do that. Hey, here's my cell phone. Give me a call. Like, listen, my daughter wouldn't even know my name. And like it would be out of control. So we actually have a process now for the calls. And pretty soon, Russell, if he keeps working with us, probably we'll have that same problem.
Yeah. So I'll just say this. I'll put a caveat to it. Just bear with me if my phone may start blowing up a lot. So bear with me. I'll get back to you as soon as I can.
Awesome. Let's see. Aaron said, I have had 2 insurance companies so far not approve my policy. Hannah, okay. So Aaron, yeah, that's tough. I mean, that's the biggest risk with this is that you don't get approved. So, keep working with Hannah. She's a wizard with finding a home through reinsurance or a different carrier. Worst case scenario, we got to borrow a life. Okay. Liz said, I have a cash value line of credit against my Guardian policy. Awesome. Look at Liz. You're already doing it. Liz is already doing it. Veda said, do you mind lightly touching on the previous question submitted by Charlie? Oh, Veda, I'd love that if I knew what the question was, but there's been, 40 questions and however many chats. Anonymous said, I asked the question before on a different matter, but the intent is the same. Can one of the 2 reseller consultants be leveraged into, gotcha. So resellers is a guy we had on to talk about how people can make $750 a month. So you wouldn't be able to, if it's you, so resellers, you set up they set up an LLC in your name, okay? And then you get paid the $750, but you can't do more than one. A household can only have one. So I think that answers it. So it doesn't matter if you got a trust, a LLC, or one of these, none of that affects this or what you're doing. So it's $750, $750 a month. Like, enjoy it, love it. It's the easiest money I think most people ever make in their life. So take it for what it is. Liz said, what does Russell mean? Cash flow the interest. I understand the interest has to be paid, which I do monthly. I don't know.
So when I say cash flow the interest, I mean pay it out of your income coming in each year. Don't accrue it in the policy or in the line of credit, which I mean that's available if you want to do it. I just don't recommend it. I recommend you pay the interest, the interest only payments coming out of your cash flow, coming into your coming in every year, so that the loan doesn't grow and eat up the cash value policy.
Yeah, and Russell, that's the only thing we teach. So Liz, just remember everything I always teach is the circle, right? Your money starts on the right side of the circle. This is your money earning uninterrupted. I'm just going to put you're earning uninterrupted interest and that. Your money moves over here to buy copy machines, to buy cars, to finance debt. If you got credit cards, all this stuff, it goes over here. So your money moves from your bank to their bank. You then pay them off, pay the car off, pay the credit cards off. Then you take the money that used to go to someone else's bank and you pay it back to your bank. But in this case, all we're going to do is we're going to add another little stopping place here. And this is going to be your CV line of credit. So your money is going to pay this down because this money right here never left your account. So that's all we're doing is we're just changing like this one equation. It's the same exact thing, but in the process we pick up and we make a little bit more money. Year 1, I think I figured it at 2.75. Year 2 will be more, 3 will be more, 4 will be more in your favor because of compound interest. We got to get through these. What REIT to invest in? Andy, do you remember when we were talking about the REIT and I was going off on a tangent and I said how toxic REITs can be? I wouldn't put my money in a REIT if you kicked me in the face, broke all the teeth out of my face and said, I'm going to keep kicking to you until you buy this REIT. Well, then I'd say keep kicking, man. It's going to hurt, but it's better off than what that REIT would probably do to me right now. Sorry.
There's a lot of office buildings sitting
like
empty right now.
I didn't mean to get graphic there, but like, man, I'm not putting, listen, I have a private hedge fund, folks. How much of my private hedge fund is invested in the stock market? Zero. Like, we're not making the money we were before because we have zero money in the market because the risk doesn't support the reward. Risk, reward. Hedge fund doesn't support the reward. I'm investing privately into companies that are non-public that eventually will IPO or exit. That's what we're doing with our hedge fund. Hell no to anything in the markets right now. I am investing in crypto, but I buy at 40 or I bought at 41 this time last week. I did it. What the F happened? You should watch it. And right now, last I checked, it was at 55. I'll probably exit somewhere around 50. I'll wait for it to do a little pullback and I'm out. I always buy at 40 or wherever it does because these are the levels. Now, if it keeps going up, we might have another, we might create another support and resistance, but right now it hasn't. Hopefully that clarifies that. Karen, how are you, Karen? I'm glad you're on here. So if I'm retired and I don't work, is this something that would work for me? Absolutely. Absolutely. Doesn't matter if you're retired. And congratulations on being retired too. Michael said, I have to put a policy on my son. How do I figure out how to fund the policy? Call us, Michael. I'll actually see you tomorrow when you pick up your free goodies here. Anonymous, what prevents me from taking out ACV on my IBC after a CV line of credit is set up? Or is there, I think what he's saying is, yeah, so if you do the cash value line of credit, the cash value line of credit through Russell is going to be collateralized by your cash value. So that means you can't take a loan from your policy or from the insurance company and a loan from your line of credit. Your line of credit will be collaterally assigned and collateralized by your cash value. So hopefully that
you come to us to borrow the money.
Yeah. Oh, there you go. Anonymous put up your LinkedIn. Okay, great. So check them out on LinkedIn. Jeff said, if I don't do 1099s, if they don't do 1099s, how is it not tax fraud or evasion? Because they give you a statement that shows you what you paid. Yeah, there's nothing wrong with that. Lots of companies actually do that. Welcome to the crypto world because they all do the same darn thing except for Coinbase. Let's see. I'm going to butcher your name. Use bio. I probably butchered it, but it says, so the bank is trying to take back some control, like borrowing a life, almost like setting up their own bank-owned life insurance. I don't know. I don't quite understand that one. You got anything on that one, Russell? That one didn't make sense to me.
I would just say to that, I mean, I think, especially the community banks, and the community banks can really play in this space because we're small enough and nimble enough to be able to do this. The big banks are just really not set up to do this. But what we realized is we were getting left out of the party. And so, that we knew that we could come in with our cost of funds. Now that the margins are really tight on these lines of credit for us. So, a lot of banks don't really like these because of the tight margins. We love them because there's no risk. We'll accept the tight margins, and we wanted to be a part of the party. We knew that the insurance companies were collecting 4 or 5% interest on these loans, and we knew that there's no risk in them, and we could come in at a lower rate.
Absolutely. Love that. Veda said, I listed the question, Chris, in the comments, but it's okay. Yeah, I apologize. Veda, I literally can't keep up with the comments coming in. Okay, last two. Benny said, why does other life insurance, why do other life insurance companies not do IBC, and why don't people talk about it? This is a great question that I'll hit, Benny. Simple. It's not that other insurance companies don't. Like Northwestern doesn't work. They just don't support using your whole life as a bank. That's all. I mean, they're a great insurance company. Same with New York Life. They don't support it. So you want to work with an insurance company, a mutually owned insurance company that pays dividends with their whole life. But you want to make sure that that company supports putting money in and taking money out, like Lafayette and One America, the two best companies to do this with, because literally those companies support this to a level you can't understand, primarily because they've been doing this for the banks forever and for companies. So that's why they're familiar with it. They're used to it. They've been doing it for decades. So they're just like, yeah, we can do this. We got a whole division for it. Mass Mutual does support it, but they don't love when you take a policy out and immediately take the money out. So you put the money in and take it out immediately in the first 30 days. Mass Mutual hates that. Okay. They don't like that. So that's why we use these cash value lines of credit and Mass Mutual. It's a perfect combo for Mass Mutual. Guardian supports it, but again, Guardian is direct recognition, perfect if you're using a line of credit. But why haven't you heard about this? If all these companies do it and all these advisors and broke-ass brother-in-law life insurance agents are out there doing this, how come nobody's told me? Go to your broke-ass brother-in-law that sold you your whole life and say, listen, you don't call him broke-ass, but call him brother-in-law. Listen, brother-in-law, I want to do some business with you, bud. You do whole life, right? Great. Is it with a mutually owned company that pays dividends? Awesome. You got that one. All right. So here's what I want you to do. I want you to set me up a whole life. And I want you to set me up a whole life, putting X amount of dollars into it. But here's the thing. I want you to set it up so it works for banking. I want you to put the max amount of my premium into the paid up additions rider. And I want the absolute minimum going into the base rider. Now, I realize that, brother-in-law, this is going to result in you earning 90% less on your commission. If I did the math correct, you would normally have made $5,500 to $9,000 on my $10,000 premium, which would have made you happy. But now you're only going to make $387. Can you help me? The answer from the broke-ass brother-in-law will probably be something to the tune of, that's not even possible. There's no way. Who told you that? They can't do that. That's not possible. I can't give you part of my commission. You're right. You can't give the commission, but you can build the plan so you make less and your client gets more. Remember the universal law. One person gives, so somebody else gets. Welcome to the infinite banking concept. That's how it works. So go to your brother-in-law and ask him that. Go to your financial advisor and ask him that. You will be entertained by the answers that you hear, because it will be very similar to what I just said.
Chris, you just hit the nail on the head, is that there really is no incentive for your advisor to educate you on this.
None. The commissions are so low that they just won't do it. We just figured out, hey, the magic in what we do is not in the commission we get paid. It is in helping thousands of people to do this. And believe me, we're not stopping at thousands. We're not stopping at tens of thousands. We're never going to stop. So that's it. It's the Walmart analogy. It's the Walmart analogy. And Walmart came up with a business model where they made pennies on the items they sold, but they sold them cheaper than everybody else. And what happened? I think you guys know. It kind of worked. Unanimous said, this does simplify the money in, money out, money back in the IBC. It definitely simplifies it. So lots of wording here. So yeah, you get a lower interest rate. Okay. You got one central point to household all of your IBC policies. So you might have 10 IBC policies. Brent's got 19. Are you working with Brent yet? We got to make that happen. He's got 19.
Yeah, I haven't done a line for Brent yet.
Yeah. He'll have one checking account. Yeah. And a lot of people are thinking, well, what if I have a trust? What if it's in my business? No big deal. Like, just different classification. So,
yeah. So you bring up a good point, Chris. So we can do lines of credit against trust-owned policies. Important thing to point out, though, is we do not like revocable trusts. So if it's in a revocable trust, and this is, I know it doesn't make a lot of sense for people that know how trusts work, but for our credit partners, they do not like revocable trust. If it's in an irrevocable trust, an irrevocable life insurance trust, we'll do that all day long. And there's a little bit more involved. We'll have to get the trust documents, and we'll cover the cost of getting an opinion letter written for the trust documents. And because we cover the cost, the max LTV on an irrevocable trust-owned policy is going to be 95%. So just want to point that out. But yes, same process, very easy to set up. We do a lot of irrevocable trust lines of credit. But if your policy is owned by a revocable trust, we will not be able to accept it. Just want to point that out.
Okay, perfect. And then this is a good question, Jameson, last question. Russell, maybe I missed it, but do I have to pay back the CV line of credit loan where the IBC you don't? So like basically, where the loan is taken from the insurance company, you never have to pay that loan back. The line of credit, kind of the same thing. I mean, technically, and Russell, you can correct me, but you never have to really pay the loan back. It's a line of credit, but you have to pay the interest. We always teach you to pay the interest on the insurance company's loan. So we're teaching you here, just pay the interest on the loan. The line of credit, I mean, if you never pay the loan back or you just keep using it, good for you. You're moving your money.
Right, exactly. So we would hope that you renew every 5 years. We hope that you renew. Let's say, worst case scenario, which we don't expect to happen, but let's just throw a scenario out there where something crazy happens with interest rates, where the interest rate on your line of credit ends up being
higher than the loan rate on your policy. And at that point, you're going to reach out to me and say, hey, Russell, I don't need this line of credit anymore. I want to cancel it. one of two things can happen. You can request to pay off yourself and pay it off yourself if you choose to do that. You do not have to do that if you don't want to do that. What would happen is we would reach out to the insurance company, have them pay us out, and whatever balance on the line of credit would be switched to a policy loan on your policy. And in the event that, God forbid, we hope it doesn't happen, but a borrower or policy owner, or excuse me, an insured were to pass away, because we're collaterally assigned to the policy, we're going to get notified by the insurance company that a death claim has been filed on the policy, and they're going to request that we send them a balance owed. So we'll send them the balance on the line of credit. The insurance company at that point is going to generate two checks. One check is going to come to us to pay us out what we're owed, and the remaining death benefit is going to go to a second check, tax-free to the beneficiaries to prevent any tax consequences. So two checks will be generated, but the short answer is no, you do not have to pay the balance off if you don't want to.
Great question. And I know there's always someone on here that's saying there's no way you guys do all this work, do all this free training to make like these small commissions. Okay, Shauna, who does our commission summaries at the end of the month, there are some of these policies that make like $8 and then they split it on the cost and the overhead. Goes really not very far, LOL, but we do take ups and downs. So she's literally talking about a commission that was $8 split probably 3 different ways, because usually there's 3 of us on each policy, depending on who took the call, who originated the call, and then the house, which is the money multiplier, gets some to pay for application teams and mapping. So take $8 and split it 3 ways. Yes, that is very real. We don't even look at commissions. When we talk to you on the phone, we're not sitting there like I used to as an advisor being like, okay, he's going to do this much. Oh, I'm going to make that much. We don't even know. Like, I don't even know. Like, I'm doing $1 million policy. I have no idea what I'm going to get paid. It'll probably be okay, but it's not, we just don't focus on that. We focus on, can we do 100 and change 100 people's lives this month? Can we do 200? Can we get to 300? That's what we talk about. How many more people can we help change their financial futures? Again, it's just a different way of thinking, but that is the God's honest truth. And whether you believe it or not, doesn't matter. I mean, Shauna is got nothing, to gain or lose by telling you that. I mean, she posted it. And then Charlie, last question.
I'll tell you this. I mean, and Chris, you just answered the question, but I hope I'm not stepping on your toes here. And I hate to cut this short, but I do have a 3 o'clock call. I got to jump.
Yeah, me too.
I really enjoyed this. But you should always ask your insurance agent who's writing the policy what their commission is.
Yes. I mean, that's a fair question to ask.
Absolutely. And they should tell you, and they most of them will, if they kind of gawk and be like, well, I don't really know. It's depending on a lot of things. They're dodging, they're avoiding the question. It's very simple. I can sit down in a couple seconds and figure it out on a calculator and get within probably pennies or dollars of what that commission is going to be. Ask them. Yeah. And if you're putting 10 grand into your whole life and they're making $5,500 or $9,000, they're not setting you up with this kind of designed policy. I assure you, because they will not be making very much.
They're selling you a policy and not a plan.
Absolutely. They're selling you a life insurance policy. Nothing wrong with that. If that's your goal, if you're looking for life insurance, like, that's awesome. Don't call us. If you want to buy life insurance, you want to buy term insurance, you want an IUL, you want a VUL, you want a UL, you want any of that stuff that's just regular life insurance, call somebody else. Call Northwestern, call New York Life. I'll refer you to some people. If you want a banking system built using this concept, this is all we do. Call us. And we put the number up there a whole bunch of times, folks, and it definitely will change your life. Charlie, I know I made you wait. I don't know if you're still on here, but can an IBC be implemented for someone that lives paycheck to paycheck? And if so, how? The answer off the simplest thing, no, because you have to be able to save money. But Charlie, we've worked with a lot of people. We've looked at, Charlie, if you're living paycheck to paycheck, that means that you make money, but you spend every penny you make. So where we need to start is a budget to figure out, where's all your money going? Well, how are you making paychecks? And then all that paycheck is going to somebody else. First, we look at that, where your money goes. Can we adjust that? Can we snowball that? Can we modify that to free up some cash so that then you can save? If the answer is no, I got bad news for you. If you hate living paycheck to paycheck, go out there and get a side hustle. Get a second job. Work on the weekends. Give up a football game and go out there and hustle your ass off to make a little bit of money to get out of that rat race of living paycheck to paycheck. There is no simple answer sometimes. Sometimes you got to rise above and figure out, how am I going to change my life? What do I have to do and what do I have to give up And that's the answer in some people's case. This isn't magic. This isn't hocus pocus. I don't have a deck of cards. I'm not shuffling money. That's how it works. And also, Charlie, you should join us the next time that Jerry comes on to talk about the Resellers Inc., because that's $750 a month that you really don't have to miss the game to get. So that would be a good one. Stay tuned. But with that being said, Russell's got to run and I got to run. I hope you guys all enjoyed this. All right, if you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel and don't ever forget to smash that alert button. We'll see you on the next one.